started. And thank you guys for coming in, Lisa, Terry, Cedric, Margaret. Michael is out of town for a couple of weeks, so we still want to maintain our trainings and make sure you are good. So we have a presenter, Ms. Shirley. Your last name?
Sheffield.
Ms. Shirley Sheffield came from Austin today to present to us on commercial real estate and lending. So we're extremely happy to have her here. And we're going to let her take over in her presentation. Thank you.
Okay. We've had a lot of technical issues with my presentation.
Are you welcome?
That's you. Okay.
Okay, perfect.
Okay. So I guess just go ahead and go to the first slide. And, you'll hear a little bit about me, a little bit about the credit union, and then a little bit about commercial lending, and kind of and stuff. Yeah, keep on going. Let you keep going.
Okay. Yeah, absolutely. Keep going.
Yeah. And this is, the reasons people will borrow for commercial lending. They're trying to diversify their investment portfolio, and then they're trying to have different tenants. You're going to have your retail, your multifamily. These are just some examples. There's going to be more than that, but storage units, manufacturing, offices, those are some of the basic commercial types of property. And then there's also another reason to need commercial real estate financing is because you've outgrown your space. And so you're not really the investor, you're the business owner, and it's owner occupied commercial financing. In some banks, that's a completely separate department. In some banks, they do both of them. Because if it's commercial real estate, sometimes it excludes the owner occupied. But where I work, it's combined. And then also, you may want to borrow because you're boosting your production. So you need extra space. So you may be expanding, or you may want to upgrade your facility. You're not really expanding, but you're trying to improve it. So it's a renovation. So all of those would be, different types of commercial loans.
Awesome. Would it be helpful would you like to press the next button?
I'm fine to do that.
Okay, stay where you are.
Okay.
I'm gonna bring this here. Okay. All right, guys, and all you have to do is just press this.
Then you're not,
okay.
And then, whenever you're trying to finance commercial real estate, it's the little arrow button, right?
Yes, the arrow.
Okay. Whenever you're trying to buy commercial real estate, there's two sources of your financing. It's going to be your lender, who are renting out money. We're not giving it, but we're renting it when it comes back. And your investors who are putting money in, and that is two sources. Some cases, if you get enough investor income, you don't even need the lender. But in some cases, you don't want to give up ownership. And so you want the lender because our rates are generally going to be cheaper than what you're giving up with a long-term investor who's taking ownership. But they're both very viable sources for financing your real estate. And then again, always seek legal advice. This slide says before acquiring investors or partners, but truly the first time you sign some legal documents with a lender, especially with a specific lender, it doesn't hurt for that to also have your attorney. Now that doesn't mean the bank's going to change anything, but it does mean that you may understand exactly what you're signing because the bank's attorney will never represent y'all. So, in Austin, we're the second, so this is Austin. So, but we're the second largest locally headquartered SBA lender. We're one of the preferred lenders for SBA. We also offer USDA loans, and we're experts in the Central Texas market, but we've really been expanding to most of the urban markets and even have some loans in El Paso. So some of the distant urban markets too, and some in the Valley. And we've been lending in commercial real estate since 2005. These are some of the groups that we sponsor. And Houston has an excellent commercial real estate women's group. it's a good one. And so that might even be something if you want to sell commercial real estate to get involved with that, but it's CREW. And I've attended some meetings here in Houston with that group, but when I was with the Austin Commercial Real Estate.
And what's the title of that again?
CREW, but it's Commercial Real Estate Women. Mm-hmm. And they'll usually, everything kind of changed with the pandemic, but usually they've got a monthly meeting, and then they'll have happy hours, networking, and different things like that. So it might be something. I just encourage you to look into it. This is a little bit about me. Been lending 20 plus years to small businesses, and I'm probably servicing probably 65 to $70 million portfolio. And it's a mix of small businesses and commercial real estate. These are kind of some of the businesses. And so you'll see some look like a commercial business, and then some look like true commercial real estate. So again, your storage unit facilities, it's right here in front of me, Mom. Office buildings, your breweries, venues, multifamily, pet sitting, rent house portfolios. Whoops, I think I just moved it to start talking and stuff. But your rent house portfolios, strip centers, like today I've already looked at an 8 fourplex units loan that I'm probably going to make. And so that's a real estate portfolio of, fourplexes. And but I don't really, one-offs are a little too small. But if somebody's got a group of them, then they're worth all that extra effort and everything. So one-off single family residence is a little bit, it's just for me, it's just more than I can, keep falling down on the priority list. Also, I've got some pet sitting businesses. I've got strip centers. I've got some industrial warehouses. I finance a few restaurants, RV parks, and professionals. So that's going to be like your attorneys, people like yourselves. So if you have your facility, if you decide to open, have your own offices and your own facilities, that is a SBA loan because it's owner occupied, or it can be a regular commercial real estate loan. So went to UT Austin, and I've lived in the Austin area since the 60s. I'm a mother of 2, grandmother of 2. I did change this one number, 42 years. So if it was from 41 years last year.
Years? Is that dog years?
No. That's how long we've been married. Yeah.
Wow.
Yeah. So,
Awesome.
and then these are just some of the organizations I'm in. Risk Management Association is a bunch of that's a boring one. It's full of bankers. But you've got commercial real estate, Central Texas Commercial Area Realtors. CT Cars, what that one is, Urban Land Institute is another excellent commercial real estate organization. And I probably learned the most at CREW and ULI out of everybody. CT Car though, and there may be something similar for Houston or for Harris County, and then member of the Hispanic Chamber of Commerce, really member of some other additional chambers, but it gets boring. I mean, anyway. So these are different types of lenders, and so this starts from the very beginning to this is the gamut. But truly, when you take your money and put it in something, you're the lender, and you expect a return. You're hopefully not doing it for charity, and that's one of the things, especially with some of my SBA borrowers that I've had over the years is, this needs to be making you money, needs to, you're not in this to, we need to not get so emotionally involved that we do it without being fairly compensated. And then family and friends can be lenders. Again, this is something I always tell people to carefully document, and that way it keeps families, it protects the family from some of the emotional issues that can occur when you mix business and family. And so to put things in writing, if you borrow money from a mother, then the mother needs to have a note, and that way it keeps people's memories mess up or somebody passes, and then you've got siblings that are angry, and this way you've got something to protect everybody. These are just some other types of loans. Residential mortgages. This is throwing out, some of the current rates, and I just pulled that up on our website. And those are for your homestead, so that's going to be consumer, and that's something y'all are all familiar with. Credit cards, that's, again, we're all familiar with that. Venture capital, this is when you're giving up some of the ownership of your business. It talks about some minimum amounts they're going to want, and they are looking at ways to scale. So like I'm a member of an angel network too. And so when they're talking to businesses to decide if they want to put their money into it, they want that business to grow fast, and they're not generally, and so that it can be sold. So they're not generally there to invest in a business that there's a long-term hold plan. They're usually hoping it'll, to get their cash out within 5 years. Maybe
angel groups.
Angel, yes. And Houston has a good one too.
Angel investors.
Whoops, I keep doing that. Let's see. And then you've got your banks, your financial institutions, your credit unions. And again, we're trying to do greater than 50,000, and really we've gotten to where we're trying to do greater than 150,000, because it's just, it's hard to make money with the amount of time and that our regulators require on our deals. Now, consumer loans, it's a little bit more, it's easier to automate some of that, but commercial still requires some hand-on, and it may at some point have good enough programs where it can be automated, but it's just not very, it's not very automated. We also can make certain types of loans that we might not make normally if we've got SBA or USDA guarantees. SBA requires that it be a business. So I can't lend to a nonprofit with an SBA loan. There was an exception when they did the PPP, but that's very, very rare. And USDA does allow you to lend to nonprofit entities like for a MUD or public utility development. That's a good way to finance that, but that's not going to work in Houston because population. But it's more for your rural counties. But still, it's a very, it's a good resource. And with the SBA right now has 90% guarantees. That's probably ending in September, but usually it's 75%. And then there's also a 504 loan product, and I'll get into that a little bit more too. And then there's alternative lenders. Your hard money lenders, these are going to have higher interest rates, usually shorter payment periods. And it seems like they'll sneak in things too. I've had borrowers get very surprised at prepayment penalties. And it's one thing to know it's there, but sometimes they've been surprised at it. They can only pay off the loan one day a month. And if they miss that day, then they've got to wait till the next month, pay another month of higher rates. I mean, so there just have certain, if it's in the loan documents, in the loan documents. But so some funny things that, that you just don't normally see. Is the types of loans, unsecured, those are harder to obtain. They're not impossible. But they usually require outstanding credit, and they're not going to be that large in size generally, unless you're talking to your Fortune 500 companies. And some of those, their bank loans may well be unsecured, but they also usually have very short terms. But then other types of loans, of course, credit, and we get so used to credit cards, we don't necessarily think about that. That's truly a loan. And in some cases, that's the business's best resource. Even though it's going to cost them money, it also gives them flexibility. Then other lines of credit, friends and family. And then your secured loans, again, your real estate mortgage, SBA, business loans. And then there's different types of business loans, your short term, your secured lines of credit, and then long term. And generally with commercial real estate, we're talking long term, but it can be a short term loan for construction. And those are, when I say short term, those are generally going to be at least a year. And usually it's got to be longer because usually you do construction through stabilization where it can service debt. So it's got enough income coming in. So if you build a retail center, then you've got to have the tenants all in there. And then the leases, a lot of times, you've got introductory lease terms that are less than what the lease terms will be in year 2 or 3. So sometimes the developer or the builder who builds this will need to plan to hold that property for an additional 2 years in order to get all the lease rates up so they can refinance it at favorable long-term rates. So most construction loans are beyond just, the bricks and mortar. And of course, these are the types of collateral, and really a person can pledge personal assets, personal real estate for a business loan, but in Texas, that's going to be harder if it's their homestead. But they could have a second home or a vacation home that they don't live in. That's a perfectly viable piece of collateral. And so I could use that. Then all your normal business assets and your inventory, accounts receivable, but then the things that most bankers are most comfortable lending against are going to be your real estate. But they can also finance equipment too. So this is all kinds of lending. So what it takes to get started. Typically if I'm lending, I'm looking at the historical operating statements, balance sheets for the borrower. So I've got to lend based on history. I also can lend for a portfolio of projects. And let's say somebody doesn't have much history, then that's generally going to mean a smaller loan because they're going to need to put more money into the deal. And equity is generally always required because it helps me know that you believe in the deal. And so that's a sign of, if somebody doesn't want to put their own money into it, that's not a very good sign. And so, or like if a spouse doesn't want to sign on a note, that's also says something, We also like a decent FICO score. 650 is usually about the minimum we'll accept. Okay.
Not going, the arrow's not working.
Don't do something.
It should be fine. Should probably
Oh, there it
There we
is.
go.
Okay. What I was holding my nose wrong. Okay, so whenever you're projecting, whenever you're trying to present a budget, remember cash is king. And so I've had people actually present me budgets where they show that they're going to be overdrawn. And so you've got to not just be playing in the numbers, but you've got to then stop and look at what these numbers, what are they saying, and sometimes I'm like, if you keep losing money in these months, then that means you've got to put in more money or you need a bigger loan or something, but you can't plan to have an overdraft. I mean, and people don't necessarily realize that they've put together a budget that's not helping them really. So, and then also recognizing that having your cash is not the same as being profitable. You can have profits because of the type of accounting method you're using where you recognize those receivables, and that's income. I mean, as in the accounting world, that's income, but you can't eat off of receivables. You need the cash. And so you've got to, when you're doing projections, you also want to think about the timing of collecting your receivables, the timing of paying your bills. History is the best way for us as lenders to predict a 1.25 to 1 debt service coverage ratio, which is what we're always looking for. And so what that means is we look for every dollar in debt that you need to service. We're going to want you to have $1.25, and SBA allows it to be a little leaner. 1.1 to 1 is what the SBA allows. And sometimes we're a little bit less stringent when the person has a completely different source of backup income. So like if somebody's in the tech industry and they're investing in real estate, I may be okay with this real estate only bringing in 1.1 because they've got a completely different source of income. If they sell real estate and then they're investing in real estate, I probably want it all to be at least a 1.25, because if this comes down, this is also probably coming down. And so that's kind of, we're always trying to think about diversifying a little bit. And so kind of when they're not going to move in opposite directions, that's when you kind of, you try to, there's just the logic there. Then we're also looking at what the loan's going to be used for. Yeah, one thing, can the seller finance a portion of a sale? So let's say there's not as much money to put down. Maybe the bank takes first lien, but maybe the seller would take a second lien behind the bank. And that, I've still got my decent collateral position. Now, I'm never going to want to be in a deal where the borrower is putting nothing in it, though. So the seller might be able to put 10% and the borrower put 10%. And then we've got an 80%. That really, we wouldn't want that. We'd want to be 75% on most commercial real estate. But anyway, that's, that's a way to get around some of the equity requirements if that seller will finance it. Or they may have more lenient terms than the bank too. Sometimes their rates are less. Usually they're more because there's a reason. A seller should charge more generally, but sometimes they don't. So it never hurts to where that's something you talk to them about. And real estate purchases, short-term working capital, and that generally refers to financing receivables. And that is a valid type of financing, but it's also higher risk, and that's factoring is one like that. And then this is kind of what the SBA will call long-term expenses. The SBA calls that working capital too, but a lot of banks wouldn't, but the SBA does. So like if you're truly paying to get your website upgraded, that's a long-term expense versus you've got a where you've already earned it, you've got a collection coming in, that's a short-term collection. You're going to be getting that money in a very quick basis. If you upgrade your website, you're probably going to get the income associated with that over the next year or two. So, and then basically your business assets.
So I have a question for long term and things like that. I know you were saying you want the borrower to contribute money.
Yes, ma'am.
But like for myself, it's like the money there, but I need the money to get to the money. So that's when the credit comes in, and then y'all start looking at things like that, right? Yes,
but yes, definitely, yes. And we will, but we don't want to put you into business. We'll help you, but we can't. You gotta bring some with you,
right?
And if you or save it, but we won't do 100% ever. We just won't. When I have done some SBA financing, it's possible in the SBA world. It's also possible there are some community lenders, some community advantage lenders, and those are even a little bit more lenient in their terms than the SBA, than your normal SBA lenders are. But the downside, their rates are higher. Mm-hmm. And so, because they're taking on more risk, because when you've brought less cash to the table, their cash that they're putting into it is increased. And so you're going to see higher rates. So there's a trade-off. Mm-hmm. And I think too, doing everything you can to keep costs down. I've had people, I still remember when I used to lend in SBA and I used to do community lending too, that were profitable, selling clothing out of the trunk of their car. And they wanted to go ahead and open up a shop. But all the expenses they were going to have with opening that shop versus they were making good money, right. Selling, and all the new skills they were going to need to learn and things they needed to think about more, so it's just growing. You just got to be careful and do it in a stepwise fashion. Mm-hmm. Slow growth is the best kind of growth because you can learn as you grow, as your company grows. These are the things I'm going to usually want with a loan. I want a loan purpose. I want the budget. I want somebody to have some experience. So I rarely really want to finance their first project. I also never like it when I ask somebody, well, how much are you looking at financing? And the answer is, well, how much will you give me? Because that's a sign they've not thought about it. They need to tell me. And suppose I suggested a number that was higher than what they thought. I mean, I never like being in the position to encourage somebody to take on more money than they might not want. I mean, and they've got the more, so I want to hear what they want. I don't want them to look to me and say, well, I mean, they need to tell me what they need. And I may not be able to get it, but then they don't want the loan. They don't want a partial loan that doesn't get them what they need either. So again, equity injection with us, it's a minimum 10% on our SBA deals. In real estate though, it's going to be 25%. And then we also look at secondary sources of income. So I do want to know that if there's issues, how are they going to handle this? And that's not necessarily liquidity or cash they've got, because you can all see that cash disappear or they put it in something and it's gone. So I like to see that other cash flow streams. I mean, liquidity is always good. I mean, we love cash no matter what, but still you like having the diversity of sources too. And if somebody is a saver, that means they also have managed to keep their means within, that they've not lived above their means. And so that's a good sign too when somebody's got cash, you know. Okay, and then let's say we've got the business financial statements, get the guarantor's financial statements, the personal statements, because we're not going to do a loan generally without the guarantee of the owner. And then if it's rental property, in some cases, I want the tenant financial statements. And so that's a good thing to have in the leases, where they have to, upon request or once a year, they provide you, within 60 days or 90 days of the year end, they provide you with their financial statements. Let's say, if you've got a retail center, because like, especially in this pandemic, 2019 didn't tell me anything about what different tenants were doing. And so if they could provide me with a financial statement that showed that their tenant was rocking along just fine, I was more likely to make that loan based on, I've got the centers, the retail centers, all their operating statements. I've got the major tenants financial statement, and I get my guarantor's financial statement. And if all's kind of doing pretty good, then that's a loan I can make. But we don't always think about tenant financials, especially not with a younger or newer investor. And of course, I'm going to want the business tax returns. People are always generally going to be more conservative on their tax returns. So that's usually more of a worst case scenario. Now, one of the problems that happens is our accountants are trying to save us money on taxes. And so they're doing everything they can to get your income down. But if they get it down so low that you're below that 1.25 to 1, I can't lend to you until you get some of that stuff where you don't write it off next year. And so I had one guy who had properties all over, rent houses, and he and his wife would go out for dinner every evening, or every time they'd go inspect their properties, and they'd write off their meal, they'd write off their travel, and go to nice restaurants and everything. And they'd maybe just drive by their rent house, and so they'd write it off, and that's great. But those travel expenses all added up. And when he came to us wanting us to increase his line of credit, we didn't call it, but we told him, you don't look good. We can't give you more money. We can't do it, because he'd held the properties a long time, wanted cash out so he could go do some more. And we couldn't do it because he'd written off so much little personal expenses. He'd written those off. And so I know why, but anyway, and so he's learning too, and so we didn't, hopefully when I get 2021, it'll look good and I can do more. And then also with many businesses, especially with the SBA, I'm going to want your business plan. And again, with the budget and the projections, and please don't, I never want a budget that's going to show, like I said, overdrafts. And then we'll want personal financial statements and personal tax returns. Any questions here? It's pretty off. I mean, what, you know, it's just everything. And this is kind of what they teach you in all lending. And these are the 5 C's of credit. Every banker is taught this, at least a commercial lender. And these are the pillars of banking and pillars of finance. And so anytime we look at a borrower, we try to address the all of these areas with that borrower, with that borrowing entity. So capacity means their capacity to service the debt. So what's their income look like? Can the business make the payments? Can they manage this project? Can they manage the business? Do they have the knowledge and the wherewithal to service the debt? Okay. The next thing though is, what's my backup plan? And this may be the second or the third, but there's a reason we take the collateral. And so I want to know, what kind of collateral do I have? And in the commercial real estate world, our collateral frequently matches the capacity, because the collateral is what's throwing off the income to services, but it's not always, because it could be, like I said, their second home or something like that. But that is my, you know, hopefully that's really more like the third level of repayment sources, because hopefully we've got the primary source of whatever that asset is that I lent against. Hopefully there's a backup source of income that the owner has and could service the debt. And then, you know, the place you never really want is to take the collateral and rely upon the collateral. The borrower also, though, wants to have enough equity in the property so that they can also sell it, and at least they may lose all their money, but at least they can not ruin their credit and their ability to get future financing, start over, not necessarily ruin, but make it harder. You know, it's not ruined, but, and I know, like I carried a home for 9 years after the oil patch days in the 80s, and couldn't sell it. The values had fallen. And so like we were just starting out the hunt, and this is way back $1980. We'd spent $90,000. The market fell out. And so the home was worth about $45,000. And so we had to carry it for a long time, but we had that ability. We couldn't afford to take a $40,000 loss, but we had the ability to service the debt. So there's different sources of income that can come into play. And then finally, we were able to sell it, and cried a lot, but anyway, we survived it though. And that was, you know, I mean, that's part of it too, you know, and hopefully on the whole, we're going to all make some bad decisions, but hopefully on the whole, we make enough good decisions. You know, capital is another one of the C's, and that's, you know, what have you already put into the business? You know, is it you know, if it's a brand new business, it's just certain dollars, but it could be a lot of time, it could be a lot of knowledge. And if you had to sell the business, or at least if the business had to just sell its assets, is there enough left to pay off the debt? And so that's kind of the capital of the business. Conditions. Oh man, this one came home hard, because none of us were doing anything wrong until 2020 hit. We got hit by the conditions in the market. Mm-hmm. And sometimes, I mean, we don't even think about conditions a lot of times. In Austin, I never have to think about conditions, but boy, we sure did when they shut down South by, and then all of a sudden you just realize it's like a bomb went off. And nobody did. I mean, that reflects, you know, that doesn't reflect on anybody, but it impacted all these businesses. And then character. Does the borrower have the history of sticking to their commitments that they've made? And in today's day and time, that's really shown more in the credit report. You know, I know, you know, I'm a banker, my husband's a banker, my husband's father was a banker, our son's a banker, my husband's sister is a banker. It's in the, but I do know that, like, when my husband's father was in banking, he knew the daddy, he knew the mom, he knew the kids, he knew the uncle. and you didn't need necessarily the credit report. But in today's time, we don't lend like that. We don't do very much. It's a bit special if you can have a relationship banking situation, but the reality is it's much more transaction based. And so that's part of why we rely so much on credit reports now. The good thing about credit reports too is back when my father-in-law was in banking, you had redlining. And so you had people that were not treated fairly with that relationship type of lending. So at least with credit reports, and there are still issues with credit reports, but at least with credit reports, it is a math formula, and you can't just say, well, this side of the tracks, no lending. And so there's a double-edged sword to some of this. But, I think it's where we are, though, is in the credit report world. What would you all say a banker thinks is the most important of the C's?
Probably collateral.
Capital?
Capital.
I'll say collateral.
I think it's capital, because you said, like you mentioned, that you would want to see what they've done toward their own business. Before you step in.
Yeah, that's a no-go if you don't have that. If you don't have money to put into it, that's a no-go.
Well, you got good points, but
What is it?
It's character.
Like credit.
It's
I
character.
had a feeling it was gonna be character.
That's the score. And if it doesn't get past the score, it's gonna be a.
well, and also though, there's been times in my career, and I've been lending a long time, where I've just thought this business is going south and they're not going to make it, and they make it, and they do what they need to do. And then there's been times where somebody declares bankruptcy and they didn't even give us a phone call, and we would have worked with them, and they just threw in the towel. And they had an attorney, that was going to make some money, and they just threw in the towel, and they didn't even call you. Yeah, and you're just kind of like, seriously. And I've seen borrowers spend their children's college fund to pay the bank back. I'm not saying that's maybe, I don't know if I would have necessarily do that, but I'm just saying they cared, and they wanted. They were going to do what they needed to do. And then I would say the next thing we look at is capacity, because I want, and especially in commercial real estate, a lot of times capacity and collateral are one and the same, because your collateral is what's throwing off the money that's servicing your debt. So a lot of times it's kind of one and the same. But I don't, if that project is not going to throw off the money to service the debt based on my best judgment, I really don't want the collateral, because that's the last thing I really want. One thing, like if you're ever in that situation, you always want to sell the collateral instead of the bank selling the collateral, because nobody wants to pay us fair price. They smell blood, versus they may still smell blood with a borrower that's trying to sell and is in a bad situation, but you're more likely to get better prices than I would. And when I say you, I'm talking generally, one is more likely. But the last thing I really want is to take somebody's collateral. I mean, and that's, it's just, we don't want to be, then we have to manage it. Then we have to run it, and we don't know. I mean, I don't know that stuff. There's a reason people do hotels, and we don't want to run a hotel, so.
I used to call like the people bluff, come get it then, come get it. They're like, we want to work with you. Why you calling with all that, saying you don't care. I know you care.
Yeah, you care. You care.
Yeah, you guys care.
But after a point, you kind of like, okay, well, I can't be doing this all the time either. So you gotta, and then you take it and you fire sale it, you sell it for 60 cents on the dollar or whatever. I remember selling drilling rigs for 10 cents on the dollar when we went on oil and gas properties. So, which it's horrible. I mean, so you charge off your loan and you go on, because we all have losses in our lives, and we don't benefit too much from concentrating on that loss. We got to cut it off and move forward. And so banks got to do the same thing too, you know, so that's kind of, you know, so they'll take it, sell it, and let's go on. They charge it off. And sometimes the banks fail too. I mean, we've all seen banks fail too. So if you got too much like that, the bank's going to go under, you know, and the FDIC takes it over. So it's okay for the depositors, but still, okay, I must be sitting here talking too much.
No, it's not going forward.
What'd you do to get it to?
Try it again.
There
There
it
you
is.
go.
Okay. And that's a little bit about SB. And y'all tell me if I'm talking too long or if you, okay.
You're helpful. I mean, some of the things we wouldn't even know to ask that you're adding, so it's great.
I've done all kinds of lending, so I'm gonna try to
I
get
like
this.
that you had a history, like a whole family of lenders, a whole family of bankers. So I know y'all have
I can't believe my
great
son's.
family reunions.
Oh, we're
Just speaking
boring.
about- I know, but just talking about money and capital. Hey, there's a lot of people would pay to be in that conversation, right? This is Cynthia.
My husband's father was just such a wonderful banker. He was, okay, and he's a good banker too, and I just try to learn. 7A loans, these are the two main types of SBA loans. There's also that community one that I mentioned, which is a type of 7A, but those are the little bit more lenient, but a little bit higher rates. But there's going to be community lenders here in Houston. I mean, we don't do that, but I know there's ones here in Houston, and then I know of some in Austin too. Anyway, that's the limit is up to 5 million, which takes care of most businesses' needs. And then 504 loans, these are just two good types of loans. The 504 can only finance real estate and equipment. The 7A can finance real estate, equipment, inventory, working capital as defined by the SBA, which remember it was kind of your longer term, could be longer term expenses. Always, the 504 requires a minimum 10% down payment. But if there's a startup, they got to put another 5% in. And if it's a special purpose facility, then there's another 5%. So like car mechanics that have the big grease thing in the middle, those are frequently treated as single purpose. That would need another 5%. But still, that's pretty good, especially if somebody's got it just has limited cash, and they can finance their closing costs in that. In a 504 though, they cannot finance working capital. In a 7A, they could finance working capital. So some of the breweries that we did those as 7A, and then in some cases you can do a 504 for the real estate and heavy equipment. So like maybe the brewery equipment, and then you can do a companion 7A for the working capital. So there's different ways, we didn't do this loan. We looked at a loan on a hotel, and we were doing that as a 504. And then we were going to do a working capital loan for as a 7A, but then the pandemic came, and then we stopped, because we weren't sure. We just weren't sure where, and they've placed it elsewhere. So it was a good deal. But and then in the SBA world, you're allowed to have an undersecured loan. So that they'd like us to have as much collateral as possible, but they don't necessarily require that it be fully secured. And so, but as a lender, we take whatever we can in the SBA world. Let me see, I'm trying to think what else when I say, but let's say you've got a rent house, or you've got a home that you used to live in California. We'll take a second lien on that with the SBA. And maybe you only have 20,000 in it, which in a several $1 million deal, that's not that much, but I'm supposed to take what I can get. And so I'll take a second lien there, even though it's really kind of meaningless. We're supposed to take what's available, but you wouldn't take retirement accounts. That's also protected. But if somebody's got an investment account that's not retirement, we probably ask for that. Or, so you try to make the loan as strong as possible, but that doesn't, without, before I don't want to talk too much, but try to make it as strong as possible, but you don't necessarily have to have a fully secured loan versus conventional. I got to have a fully secured loan. Oh, yeah. And the 504 will have fixed interest rates. This is another good point. The 504, 40% of that, it's actually 2 loans you make. You make one loan, let's say you get 10% down, the bank makes a loan for 50%, the SBA makes a loan for 40%, okay? The SBA's loan is fixed. Their second lien position, but it's fixed for 20, 25 years. Rates right now are about 3%. That's good.
Yes.
Yes, ma'am?
Sorry, so
Perfect.
variable interest rates, does that go with the 7A
That's what
loans?
she's saying.
Yes, ma'am.
Okay.
Yes, ma'am. But there's also, so like variable interest rates, that can mean that it adjusts every 5 years, you know?
Mhm.
And so in the 504 world, where you've got that SBA that's fixed, then you'll have the bank where they still may adjust their portion, that 50% every 5 years, but you still got a good blended rate.
Okay.
Now a bank could choose to fix it that whole time too, but it's just not it's not that common. Usually their portion would be adjusting at least every 5 years, because most banks don't want to have a fixed rate for 25 years going out.
Mhm.
But the SBA can do that because it's not their money. It's our money. But it benefits us all, we hope.
So when someone comes to you, that's the point of you having like all of that, the criteria that you asked for, which was the business purpose, all of that, so that you can come up with the type of loan that they probably need.
Try to do that. Yeah,
Okay.
yeah. Or especially if I can't make them, if I can't do it conventionally, then I've got enough knowledge to know, well, might work this way, you know.
Okay.
It's just SBA loans, I like them to be where it's almost something you'd make. Because if there's too many negatives about it, it's okay if maybe there's one negative, maybe it doesn't have enough collateral, or maybe they don't have as much experience as I'd like. Or maybe they don't have enough equity. But if it's got a lot of issues with it, that's when I kind of just don't even want to do it.
Right.
But if it's just got one or two, and most deals, nearly every deal has some issue, but
Right.
anyway. Oh, and yeah, this is the amount of equity down, it's 10 to 20% down. You can tell who did this PowerPoint, it's me, and that's why things aren't quite, but I mean, you can always put more down, but, and technically too, in the 7A world, I think it does allow 100% financing. It's just not very realistic that you're going to find a lender that does that.
Not going for it. Let's try it again.
It might be.
Is it a
anything below-
delay?
You have anything else below 10 to 20 down? Or
Ah,
maybe it's still
I
trying
don't-
to
I-
populate.
oh, well,
Yeah.
okay, maybe you're right. Who knows what I have. Okay, and then this is a little bit of information about USDA loans. I don't have much experience in this, as in none, but we've sure, my manager does, and he'd love to do some. So these are some of their, you know, again, it's real estate related though. It's in rural counties. But it's also very good financing. And I think it's 90% also guarantees, good interest rates. But it does allow some of the nonprofit, you know, like utilities, financing of that. I've got a nursing home that we've put them together. Between my husband and I, we've put an investor in with assisted living facility. I shouldn't say nursing home. And so in this assisted living facilities, in an old facility that they've had for over 40 years, and they need to upgrade. And they've been working with one investor on real estate, and that wasn't working because their expertise is taking care of their patients. They're not expert at, you know, developing property. And so one of my customers that I'd introduced to my husband, just, you know, I think that we went to dinner together, you know, as a thank you for him bringing me some business. Anyway, he knew this nursing home facility and he knew my customers, so he put them together. Now they're wanting a 90% loan to value loan with the USDA. We're not going to do it because we'll only do 20%. The USDA also gives 40-year terms. We won't do 40-year terms. but there are lenders out there that will. There's fewer, I mean, there's going to be fewer of that, but so I'm not making that loan and my husband's not making it, but we've kind of facilitated something to happen so that the assisted living can get a new assisted living facility and on favorable terms where it's good enough for the real estate investor too, because it helps their return. And I don't know as much about these. I've worked for one for about 2 days. And I wasn't comfortable. I wasn't comfortable. I mean, they seem like nice people, but I wasn't comfortable. It's got a faster close, but one of the things that bothered me is that all the funds may not be available on a timely basis when you do a draw on a loan. And I can go back to that a little bit, and then they can lack flexibility if you've got any issues, because they don't have, like they maybe did a loan with only 10% down. When I've got 20% down, I can work a little bit more easily with a borrower than they can. And they just don't need to. Their goal, they may be much more comfortable owning that collateral than really what we want to be.
Yeah, they're more lenient on the credit too.
They're lenient because they're expecting that a certain portion of their portfolio will go south, and we do our best to not have any of it go south. So let's see, it's pretty easy to obtain. They're not necessarily going to look at your credit, lower down payments, higher rates. And what I saw with the place that I worked at for those 2 days is they would approve a loan, and so it might be a construction loan. And so every 30 days or whatever, the borrower would ask for money, but they would only have maybe the first 2 draws with investors. That's right. And so the next draws, it wasn't assured that they'd have that money to fund the rest. They just would they just say, we got to find investors. And that, I mean, yeah, that's right. And I just was like, I can't do this, because versus a bank, they know they're going to have the funds, you know, and they'll just delay the project until they can gather up that's right. And that doesn't work very often. Yeah. So I was just like, because it's also my reputation, and people know me, they know and I didn't want to be, because they'll come to me, they'll come to a place because of me. And that was when I found out that I can't do this. This is more on alternate lenders. These I'm much more comfortable with. Lift Fund and People Fund. People Fund is in Austin, so it's more Central Texas. These are community lenders. Lift Fund is Texas and New Mexico. They started out of San Antonio, started as Axion. They started as a micro lender. People Fund, I can't remember. I know they do micro lending. They also do SBA community lending, and they both do. Lift Fund also does 504, and they provide kind of also counseling for businesses. But those are nonprofit lenders that I think do a good job. There's also some online lenders, where they and those I used to have a name of one that I would put up there or talk about a little bit, but I really don't know any like that. I know that there's some where they require you to get, before they'll lend to you, they require you to get at least 10 friends and family to also put in money, and that those are the people that get defaulted first if you default. So there's some things that there's some ingenious ways they've come up with to finance businesses. And so there's some out there, usually their interest rates are 18, 20%, so they're going to be up there, maybe even higher. But that doesn't mean they're unethical. That's just their business model, so versus the alternate money. I mean, that doesn't necessarily, I guess if you sign it, but I just didn't like it. So, because people didn't always know what they were getting into. Ooh, I can't remember what my advice was. Oh, yes. Okay. Yeah, these are, frugality, trying to spend less than what we earn, building your cash. And as you build it, focus on your cash flow and your liquidity. You've got resources, your accountant, your attorney. Every area has an SBDC. I don't know Houston's, but usually they're associated with a junior college or a university.
What is SBC?
Small Business Development Center. And they get SBA grants to provide counseling to business owners. And they help with budgets. They'll help with, they'll help with projections. But they're only for businesses, because so they won't help a nonprofit. But then the SBA.gov is it's got more information than you can ever, but it's got templates for budgets, it's got templates for business plans, and most areas are gonna, especially Houston. You've got, it's probably almost overwhelming how many resources y'all might have, but you've probably got incubators here. There's a good incubator in Austin. Because
I've never heard of the SBDC.
It's probably associated with, there's probably a college here that's got one that's associated with it.
So it's kind of like what business students.
No, but for some reason they seem to team up together, and so it may be like it may be though that some of their students are developing a business, and they may give their college an ownership interest in that. Because I think UT's done some of that. And so maybe that's part of why there's some, but I know like when I was in Waco, MCC had an incubator or had SBDC, and I don't think there was that kind of a deal that was going on with the university. So they're generally with them, but there's probably one here in Houston too. And there was something else.
What's the incubator?
Yeah, an incubator. That is where usually it's a nonprofit, but it's kind of like a WeWork, only there's resources to provide, what a WeWork facility is. That's kind of where everybody comes in, and it's collective workspace. An incubator kind of has where a business will have their own little cubicle. They can share the copier. There may be a receptionist. The incubator that's in Austin provides accounting for their clients, and you become a client kind of, and it's probably a nonprofit, but they provide accounting because they've found it's such a hardship for young businesses, and so they just decided to start doing that, and they keep the QuickBooks, but they'll usually conduct classes. So I've gone into that one and probably deliver this one, they'll bring in accountants, they'll bring in attorneys, they'll help people understand their QuickBooks, because just because if you don't understand it, or they'll help them set it up, they'll help them figure out what kind of insurance they need, but they help the businesses grow. And the one that's in Austin that I've worked with, they started with the board members with the Hispanic Chamber. And several of those board members knew this was a need, and so they started this other nonprofit. There's one with the Texas State University in San Marcos, and it seems to feel more like tech, and it has like labs, and so it's got laboratory and germ-free zones and things like that. But then it also has some of the traditional, where you've got a little office and some things like that, and it's just less expensive.
Looks like our SBDC is at U of H. University of Houston.
Yeah, and then financials, like one of the things that I look for, if they don't have in their budget accounting, then it's hard for me to lend to them, because I got to see their financial statements. That's what tells me how they're doing. And that's truly, a business owner is going to have their ways of knowing that they made money that day or they made money that week. But I'm not going to know that. I've got to see the financials. And so if they're not paying for the accounting, then I know I'm not going to get the information I need to prove that I've got a good loan. And yeah, they may be giving me their payments, but it's more than that in the commercial loan world. I get annual financial statements. And with this pandemic, I was calling borrowers every month, even though I hated doing it. And so sometimes I'd stretch it out and it might be 2 months, but we were asking them for their financials. you know, I'd kind of, and then kind of now I'm doing it about every other month. And so half of them, I'm kind of like, well, no update.
A redo year.
But they're asking me for, yeah, it's been, they've been asking, you know, because we're trying to upgrade our loans. Because we downgraded the whole portfolio of a lot of loans that were SBA especially. And then some of the real estate investments, they've been okay. But we had to have the financials to prove that it didn't need to be downgraded. And now we're upgrading, but I got to have the financials to prove. And so, yeah. So it's been, so I've been getting it. And then, or we got to know whether we need to charge it off. You know, so.
When you say downgrading, do you mean the existing lines that they have and you're lowering? What do you exactly mean when you say downgrading?
You grade every loan, like the highest grade loan CD secured, no risk, no, I mean, you know, so that's gonna be your highest grade loan. You make the least money on it too, but, and then you've got, you know, maybe long time old business, lots of cash flow, lots of collateral, that's might be a 2. And 3 is kind of most normal businesses. 4, we're starting to watch. 5, but these have been downgraded to 5 or 6. 7 and 8, maybe you feel like 8's a loss. 7 is where you maybe you feel like there's a strong likelihood for a loss. And see, the regulators will ding us if we take a loan from 2 to 8. They want to see our loans do this so that it looks like we're monitoring our portfolio. If I'm not monitoring my portfolio, I'm not doing my job really. And so, and they don't want my first sense of a problem loan to be when I don't get paid. They want to have a lot of preparation. They want, you know, and then like we're supposed to present them, we're supposed to tell the regulators, show what our problem loans are. What we anticipate being upgraded, what we anticipate getting worse. And so, yeah, so that's what I mean. And so 8, I think, is the lowest it can go. And then you charge it off, you take it off your books, but you still got it, you know, but it's not low. It goes from being called a loan to being an asset because you foreclosed or whatever, you know, and then it's something, it's different. Yeah, it's a piece of real estate or whatever, you know, and then you've got to monitor those because you can only keep them on your books a certain period of time.
Do you ever downgrade before they default?
Oh,
Because
yes.
of their financial?
Oh, yes.
Okay.
Oh, because we've downgraded because of the pandemic, because it's a brewery and they're no longer selling any beer and all the bars have shut down, or it's a restaurant and nobody's coming in, or it's a hotel and nobody's traveling. So yes,
Sort of like say preparation before.
right. And we didn't necessarily take them to 8s though, but we took them to where we're monitoring them, and then we prove that we're monitoring it. We're doing, and that way the regulators have confidence in our ability to manage the credit union. Even though, I mean, I'm not managing, but the people.
They don't want to take you over.
No, they don't.
They don't want to.
They don't want to do that. Yeah, if you lived through the 80s and you, there were, the FDIC did own a lot of the Texas real estate and properties. And I think that's why we've done better in some of these later recessions, because they learned a lot about how badly things went for Texas. Partly it was because of the regulators pushing banks to probably foreclose faster. They took over the banks faster. I mean, and it caused a real hard recession in Texas. And so later subsequent recessions, they've been a little bit more, they've worked with banks a little bit more. And that's allowed banks to work and credit unions to work more with their clients too. So let's see.
So one quick question, when the market crashed and was it Washington Mutual went away, did Washington Mutual not monitor their loans as well, and that's why they have to be taken over?
Yes, that's very.
Or was it like a different situation?
They could have also lacked liquidity.
Okay.
I'd have to, and I'm not going to be familiar with really exactly what happened, but they could have also lacked liquidity because, and then others could have been uncomfortable lending to them. So in the banking world, they'll lend money to each other, but there can be, you can not be comfortable lending this bank money, you know, so I don't necessarily know though, really. I just tell you, but I don't know because liquidity is a big issue too. Because remember, all of our assets as a bank are in loans. And if all of a sudden people are trying to pull their money out of the bank, generally we can borrow elsewhere or you can borrow from the Fed. But if people don't want to lend to the bank, then they can't meet their obligations when the deposit holders come to us to get their money out. You know, but usually we can get money from the Fed or something if there's a kind of a run on the bank or something like that. But I mean, and then this is another thing too. If you know you're going to need 9 months to build your project and to get to stabilization, ask for more, double it. Because people always think they're going to be moving along faster than what they can. And Houston,
double it is the best advice because I've always seen it that way too. I ask a little bit and I end up doing double, needing.
Yes, you do. Yeah. So I don't know what all this. Okay, these are all the things we do. Maybe that's probably and we speak. Yeah. So anyway, I think that's everything. I'm so glad this all. I'm sure glad it all worked out because I'm not sure what all I would have talked about.
Ask Valerie, she got any questions.
Oh yeah.
She on mute.
Yeah, if you have any questions, go ahead and unmute. I know they were in the chat, her and Devin. Devin had said capacity and capital for his answer.
Okay.
And Valerie also
No.
mentioned the University of Houston as far as.
Oh, good.
SBDC.
Okay.
So, Val, are you there? See, she unmuted.
Yes, I'm here.
We don't hear you. Wait, I hear you. Hold on, let me get the volume.
Do you need me to?
No, it's fine. I need to turn the volume up on the computer. I mean, on the.
Valerie, we're coming.
Go ahead and speak, Val.
I didn't have any questions. I was just letting y'all know that the University of Houston Small Business Development Center is a very, very good place to find a lot of information about starting small businesses, and they have a lot of classes that you can. Some of them are free, some of them aren't, but they do have a lot of classes that can get set up. So.
Well, that's good to know. I'm glad you've had some experience with them then.
Well, this will help me
Yes,
too
yeah.
to know.
To in Houston. Yeah.
Now we just need to
Perfect.
find the
Thank you, Valerie.
incubators. Where the incubators.
Definitely. Any other questions, Devin? Do you have anything?
Okay.
I would consider starting.
Yeah.
It's
So
a
let's
start. Yeah, it's a start.
Perfect. All right. Well, I don't think
Wow.
there Devin goes. You have anything to say or any comments?
Oh,
Devin?
no, I don't have any questions. It was a great presentation. I learned a lot. You know, I'm
Well,
going to
thank
put all
you.
this information to use. You know it. Thank you.
Well, it's always a pleasure to have Steve. Thank you for tuning into the training day, both you and Valerie. Maybe next time y'all can come in, get you some lunch. But if that's all, no more questions, then y'all give Shirley a round of applause and thank you again for coming on.
My pleasure.
So I'm gonna go ahead and end the Zoom. We're gonna eat, and y'all have a great rest of your day.
Yes, thank you for coming in. That
Thank
was
you,
very
thank you.
interesting.
Good.
Thank you.
My pleasure.
Perfect.
All engaged.
Yeah, man.
It was